Hey, welcome back. Today, we're diving into a really fascinating story from the world of energy. We're talking about Chevron, the oil and gas giant, which just came off an absolutely incredible 2025. I mean, we're talking record-breaking numbers, huge strategic moves. But when the analysts finally weighed in, their conclusion was, well, it was a little confusing.
So let's just get right into it. How can a company be firing on all cylinders, have its best year ever, and then get a rating that basically says, yeah, the price is about right? That's the puzzle we're going to unpack right now.
Okay, so let's set the stage. To really get why the analyst's view is so interesting, you first have to understand just how insanely good Chevron's 2025 really was. Seriously, it was one for the history books.
Let's just start with a gigantic number. In 2025, Chevron's daily production hit a record 4.05 million barrels of oil equivalent. And look, we're not just talking a small increase here. This was the highest full-year production both worldwide and in the US in the company's entire history.
And this didn't just happen by accident. On their earnings call, the CEO, Mike Wirth, he put it perfectly. He called 2025 a year of execution. This success was all part of a clear strategy that was just playing out exactly how they drew it up.
So we've established they had a monster year, but how did they actually pull it off? And maybe more importantly, what are the key things that have investors feeling so good about the future? Let's get into the bull case.
All right, first up, the really big one. A move that analysts say basically answered the single biggest question that was hanging over the company for years, the acquisition of Hess Corporation. This wasn't just buying another company. This was a total game changer.
So what's the big deal with Hess? Well, the crown jewel is a 30% stake in the Stabroek block over in Guyana, which is this massive, low-cost, super high-margin oil discovery. Analysts basically say that this one move solved Chevron's entire long-term growth problem and created what they're calling a premier portfolio.
But it wasn't just about getting bigger, it was also about getting leaner. In 2025 alone, Chevron made good on a promise to cut structural costs, and they stripped out a cool $1.5 billion.
And get this, they're not even done. They've already upped that target, and now they're aiming for up to $4 billion in savings by the end of 2026. I mean, that shows some serious focus. And all this discipline feeds right into their other major strength, the Permian Basin, right here in the US. An incredible 75% of their massive position there comes with low, or in some cases, zero royalties. That is a massive built-in cost advantage that almost nobody else can match.
Okay, so the bull case is pretty compelling, right? You've got a game-changing acquisition, aggressive cost-cutting, and this amazing core asset. But that's only half the story. To solve our puzzle, we have to look at what the bears, the more cautious folks, are seeing.
The performance has been amazing, and the strategy looks solid. But as any good analyst will tell you, you always have to ask, is the future ever really risk-free?
And this slide just lays out the whole debate perfectly. On one side, the bulls see all that high-margin production from places like Guyana just gushing free cash flow. On the other side, the bears see a company that's super dependent on the price of oil, which is great when prices are high, but pretty risky if they fall. The bulls love the Permian as a cost leader. The bears worry that focusing on such a popular area could lead to rising costs. It's a classic Wall Street tug-of-war.
So, we've got the strong bull case and the careful bear case. Now, how in the world does an analyst take these two completely different stories and land on one single conclusion? Let's get to the verdict. First, a quick but really important definition. When you hear an analyst talk about a fair value estimate, they're not just guessing. They're doing this deep calculation of what they believe a company is truly worth based on all the cash they think it's going to make in the future.
Okay, so let's look at the actual numbers. On January 29, 2026, the stock market said that one share of Chevron was worth $171.19. That's what people were actually paying for it.
And now for the big reveal. After plugging in the Hess deal, the cost savings, all the risks, all the future growth, the analyst's fair value estimate came out to $171. I mean, look at that. It's practically identical. So what this means is absolutely crucial. The market isn't missing a thing. All of Chevron's amazing performance, all of its incredible future potential, it's already baked into the stock price. The analyst's verdict is crystal clear. The stock is fully valued. And this right here, this brings us to the central dilemma for any investor.
We've proven it's a fantastic company that just had a phenomenal year. But according to this analysis, it's trading at a perfectly fair price. There's no obvious bargain here. And that leaves us with the ultimate question. When you find a great company that's selling at a fair price, what do you do next?